Hello, my name is Philip McGann from Claritude Financial Planning. Thanks very much for watching the webinar. Today's information is general advice. It's not personal advice. It does not relate to your personal circumstances, even though it may appear it does. Please do not take any action based on the information you hear in this webinar without discussing the same with me to look at your personal circumstances. Today's topic is going to be the Downsizer Contributions into Superannuation. This is a new regime the government has brought in over the last couple of years, and it's very attractive if you qualify under certain criteria. So what is it? Basically, it's a new criteria to actually put contributions into super, and ostensibly the government has brought it forward and sold it on the basis that they are trying to increase the housing stock, particularly in the capital cities of the major capital cities of Sydney and Melbourne, trying to free up the amount of capital that is tied up in those properties and allowing more elderly people to actually downsize those properties and actually go into something a little bit more suitable for their circumstances potentially, but freeing up the capital. Now, that's the government's main criteria they've announced, but underlying all that is very much the scenario that they are trying to make some of the exempt capital accessible capital under the age pension assets test. At the moment, if you have a lot of capital tied up in your principal place of residence, it's not counted towards the assets test for the age pension, so you may well qualify for that. But as soon as you sell that property, those funds are then counted and you may well see your age pension entitlement reduce or be extinguished altogether. So on that criteria, that's what the government has probably really brought this in for. Is it still a good idea? I would argue it is, because there's a lot of people out there who do not qualify for the age pension, and this allows them past the age of 65 to put quite a lot of money into superannuation, $300,000 each for a couple, so $600,000 from the sale of a home, and that is an attractive proposition. Or even for people who qualify for the age pension or a part age pension, even if some of that is reduced or extinguished, they may be better off having those funds available inside super and in pension format in a tax-free environment than solely relying on the age pension. But individual circumstances will dictate whether it's worthwhile or not. Now, there's a lot of rules in relation to it. So basically these run through to about 8 or 9 different criteria. You must be over 65 when you put the funds into superannuation, but there's no upper limit. So there's no age limit on that. The property in question must have been your home, and that property must have been lived in or owned by you or your spouse for at least the previous 10 years before sale. You cannot have an investment property primarily that you are selling down. The property in question cannot be a houseboat, it cannot be a caravan, it cannot be a mobile home. Right? The government's got certain criteria they're trying to sort of work towards there. The home must be your principal place of residence, so it qualifies for exemption under the capital gains tax regime to allow you to claim an exemption either fully or partially. Right? So that's got to be part of it as well. The property, when you're putting those funds in, you actually have to put the contribution in within 90 days of receipt of the proceeds from the settlement. So that can be a little bit of a tighter time frame, so people need to make sure they do it correctly. You need to put the right forms in. This is administered by the ATO, and they are the final arbiters of whether you qualify as a correct contribution under these rules. So you need to put those forms in at the same time as you're putting your forms in for your retail super fund or working things through with your accountant under a self-managed super fund contribution. And you can only do this once, right? So you can't come back into the future to keep on selling your home to get more and more funds into super. But still, 300,000 each for a couple, 600,000. It's quite a lot of funds available to bolster your end super balance and then to actually allow you to convert that into a tax-free pension, but you can only put 1.6 million into the tax-free pension, obviously. So this is an attractive proposition where you can get a lot more funds in. It doesn't count towards the other caps. So the concessional caps, the non-concessional caps, you may be able to combine those in together if you're eligible under certain criteria to actually get some of those funds into the mix as well. So this is attractive, I feel, as I said at the beginning of the webinar, because of the age-based limit and the amount of funds that you can get into super at a latter stage in your life, which is attractive, but it's not for everyone. Whether it's for you, we'd have to see. And really, that's the scenario that you need to look at. If it sounds a bit complicated, Well, it is a bit complicated, and there's rules around it, and as a lot of government criteria are, there's lots of rules to catch you up. So you've got to make sure that you adhere to those rules and don't run foul of them. But I'm here to assist as best I can if you would like me to have a discussion with you on this very topic. Now, you can give me a call on 0491 686 236 or go to my website claritudefp.com.au and leave a message for me there, and I can contact you to discuss your personal circumstances to see whether this is worthwhile for you to consider as part of your retirement planning. My name is Philip McGann from Claritude Financial Planning. Thank you very much for watching the webinar, and I'll see you again soon.